In this course, I will teach you everything you need in order to become successful in day trading. I mainly trade Forex, so the course will mostly focus on that, but most, if not all you learn in this course can also be applied in crypto and stocks trading. In this video, we'll go through all the basics you need to know before we dive into the chart and start trading. It will be a lot of information to digest if you're entirely new to trading, but don't worry. Most of it will become much more understandable as we go through examples and such later in the course. The first question we need to answer is, what are you actually doing when trading currencies? When trading currencies, you are buying one currency and selling another. This means that in order to buy euro, you need to sell, for example, euro US dollars. This is what you do when you are going on vacation to another country. You go to the exchange office in the airport and tell them that you want 200 euros. They will have a quoted exchange rate that says that you need X amount of US dollars for every euro you want to buy. You then do the exchange, smile and walk away. Obviously, it would be really slow and frustrating to be a trader if you have to go to the exchange office every time you wanted to make a trade. For traders, we use brokers on the internet. These brokers allow us to trade currencies with a click of a button. I'm not going to go in detail on how the spot forex market works, nor am I going to talk about futures or options in this course, but know this, most traders use CFDs or contracts for difference as they called when they trade. When trading CFDs, you're not actually buying or selling anything, but you bet on whether a currency goes up or down in price, while your broker takes the other side of the bet. This also allows you to use a margin account and take advantage of leverage, but more on that later. Before we go any further, I think it's important that you know how to read a currency pair and understanding what the price actually is. By the way, all technical analysis and uses of price charts will be done in TradingView. You can use TradingView for free, but it has some limitations without a paid subscription. I'll show you the basics of TradingView in a later video. Currencies always comes in pairs, such as euro versus the US dollars. The first currency in the pair is called the base currency, and the second is called a quote. The price reflects how many of the quote currency you need to buy 1 unit of the base currency. The price is usually displayed with 4 decimals, the exception being the Japanese yen, which only has 2. The last decimal in the price is called a pip. When trading, we measure the movement of price in pips. So if the price goes from 1.2110 to 15, it has moved up 5 pips. Sometimes the price is displayed with a fifth, or for the yen, a third decimal. This one is called a pipette, and is 1/10 of a pip. Pipettes is usually used to quote the price of spread, as it's often under 1 pip. When we trade a currency pair, we want to buy it or place a long position, as it's called, if we think the price will go up. And if we think the price will go down, we place a sell position, or a short position as it's called. When we want to buy or sell a currency pair, we get 2 slightly different prices. The difference between the 2 is called spread. In the case of the example, the spread is 1.7 pips, or 1 pip and 7 pipettes. What this means is, if you place a buy order on a currency pair at 1.1005, your order will be filled or entered at 1.10067. Which again means that when you enter a position, you're already down 1.7 pips. The spread is usually dynamic, meaning that it will change throughout the day. In forex trading, we use lot sizes to define the amount we want to buy or sell. One standard lot is the same as 100,000 units of the base currency in the pair you are trading. A mini lot is 10,000, a micro lot is 1,000, and a nano lot is only 100. When you want to buy or sell a currency, you need to specify the amount you want to trade, and this is quoted in lots. For example, you want to place a buy order for 2 standard lots. As traders, we want to take advantage of small incremental movements in price. To be able to make any real money from these small movements, we need to trade a big amount. But what if you don't have $100,000 laying around? That's no problem when trading forex. The solution is to use a margin account with leverage. Simply put, when you use a margin account, you will be able to open large trades while only using a small portion of your trading account. The way this works is that your broker locks up a portion of your available funds or margin as collateral. Then your broker gives you the rest of the buying power you need to enter the trade. The extra buying power is called leverage. The amount of leverage a broker offers is stated as 1 to 30, 1 to 100, or even 1 to 5,000. To give you an example of using leverage, let's say that your broker gives you 1 to 100 in leverage. This means that you only need to have $1 in margin for every $100 you want to trade. So then you can open a trade worth $100,000 on euro versus the US dollar while only locking up $1,000 in collateral. The best of all is that if your trade goes your way, you get to keep all the profits, even though you only had 1% of your own money in the trade. So instead of making $10 on the trade with your $1,000, you made $1,000. But what's the catch? There is always a catch. The leverage position goes both ways, meaning that if the position goes against you, the losses will be accelerated as well. So instead of losing $10 on the trade, your entire $1,000 can disappear in a blink. Most brokers also have a margin requirement. What this means is that you need to have a certain amount of available margin on your account when the trade starts to go against you. If you fall below this requirement, your broker will give you what's called a margin call and close out your position and lock in the loss. The reason they do this is to avoid that your account balance goes below zero. Most brokers guarantee that you can't lose more money than what's on your account, but check what applies to your broker before opening an account. But you don't have to be afraid of this happening if you trade using proper risk management. We will go through how to do this later in the course. But how does the price actually move? As you might have guessed, the way we make money in trading is by buying a currency when the price is low and selling it when the price is high. Opposite, we want to sell a currency when it's high and buy it back when the price is lower. But what makes the price go up and down? The only way the price of anything can go up or down is when there is an imbalance between the buyers and the sellers. If there is no imbalance, everyone agrees that a given price is where it should be. So if the price of an asset is 10, then the only way it can go up to 11 is if anyone is willing to buy it at 11. This means that the person buying the asset at 11 expects that it should increase in value. And the only way the price could go from 10 down to 9 is if anyone is willing to sell it for 9 because no one is willing to pay more for it. It's the belief and emotions of the other traders that is moving the price up or down. If more people believe that the price will go up than there is people believing it will go down, the price will go up. What this means is that anything can happen at any time. As you will learn later in the course, there are analysis and other confluences that give a trade a higher probability of going in your direction. But always remember that it's people that move the market, not a technical indicator. So, to sum up everything to this point. When we trade, we use a margin account with leverage to trade bigger positions than we could using only our own money. We know that we only trade CFDs, which is basically betting if the price of a currency pair is going up or down. When we enter the chart of the currency pair euro versus the US dollar, we know that the euro is the base currency and the US dollar is the quote. We then want to place a buy order or a long position of 2 lots. We know that 2 lots is equal to 200,000 units, meaning we need to have $2,000 in available margin to open this position with a leverage of 1 to 100. Before entering the trade, we check and see that the spread is 0.3 pips or 3 pipettes. And lastly, we know that it's people that moves the market, and that because of this, we can never know what will happen next in the market. We only use probabilities to give us a higher chance of a trade working out. Losing is part of the trading game. We barely scratched the surface of what we talked about in this video, but I believe that we can't go too deep either on each subject. If you want to learn more about the things we talked about in this video, I'll leave some links in the description. In the next video, we'll look at the different types of analysis we can use in the market to find out where it's possibly going next. Make sure to like the video and press that subscribe button so that you don't miss it when the next video gets released.